Welcome to ThePrint. We have with us today Ela Patnaik, a noted economist and a professor at National Institute of Public Finance and Policy. And we are here to talk about the RBI's announcement today of a 25 basis point rate cut in the repo rates. The RBI cited weakening growth impulses led by a slowdown in investment and consumption to justify its 25 basis point rate cut. So the first question, ma'am, to you is whether the rate cut was expected?
Yeah, pretty much. Given the GDP numbers that came out and the job numbers that came out, and inflation being more or less muted, and according to the RBI's target, also given the 25-25 that we've seen in the last two policies and the way people were voting, markets were pretty much expecting this rate cut.
But food inflation now seems to be a worry. We also have an uncertain monsoon. That is, we are worried about how the monsoon will also be there. So.
Yeah. So food inflation has inched up a little, but food is not directly impacted by rate cuts, and the policy rate usually tries to impact demand 2 years or 1.5 years down the line. So food inflation doesn't affect the policy rate decision as much as core inflation does, and that is still within range. I think we should put at rest fears that a lot of people used to have when the inflation targeting framework was put in place and enacted, when people used to think that because of the volatility of food inflation, we won't get rate cuts when food inflation inches up, and that's not happened. And I think this time it's a good signal that it's not that whenever your food inflation, which is determined often by short-term factors, sometimes seasonal factors, sometimes the rainfall or other conditions in the market, that's not driving the policy rate entirely. And so now you are seeing this rate cut.
The monetary policy statement seems to be very worried about a growth slowdown led by a demand slowdown.
Yeah, I think what comes out very strongly in this statement is that the decision was based much more on the slowdown numbers that have come. So investment slowdown has been visible for quite a while, but I think what has come out now is a slowdown in private final consumption expenditure. So, we saw this auto numbers, some FMCG numbers, and the statement says that rural consumption demand is lower. If you look at the output series that they talk about, the words muted, anemic, moderated are often used, which really gives you the sense of a much broader slowdown. So it's not just investment and exports, but it is also a broader slowdown in domestic consumption demand. They also talk about a slowdown in global demand, which might happen, and especially with the US-China trade wars, that would be a further global slowdown.
That is what probably prompted a unanimous decision rather than a 4-2 decision that we have seen so far in the previous two rate cuts.
Yeah, absolutely. So this time the decision was unanimous, and that really conveys the sense of the whole committee feeling that this is a time to cut rates. They've also changed the stance of monetary policy from neutral to accommodative, and what that really means is that you're likely to see more liquidity and you're likely to see more rate cuts as they try to pump demand using monetary policy. I think it's also important that at this time the tax numbers came out, and there's very little scope for expansionary fiscal policy. So with fiscal policy not being able to expand, the burden will fall more on monetary policy easing.
But transmission remains a problem because banks are hardly passing on the rate cuts to their final consumers.
Yes, absolutely. So, the problem that we've seen is that out of the last two rate cuts that we saw, hardly any effect on lending rates of banks. And unless that happens, no matter how much of policy rate cutting you do, you're not going to get a demand push up. So they've set up a committee to look at the liquidity management framework, and they've said they'll communicate better. And that's really essential. That's critical for a transmission to happen, so that other rates go down when the policy rates go down. They should go down not with a very long lag, because the economy can't really afford to wait. So the RBI now has to turn around and work much harder on the transmission.
There also seems to be some disappointment that no concrete policies were announced with regards to this whole NBFC liquidity crisis.
I think the NBFC crisis, that is a very difficult one to deal with. We are still talking about it as a liquidity crisis, but many people have started saying that it is perhaps a solvency crisis now, and many of the assets that these NBFCs are holding, such as real estate assets, may not even be may not have as much value as they are being marked at. So then, instead of just a liquidity crisis, it may be a solvency crisis, and it's not an easy one to solve. I mean, one thing could have been to tell banks to lend to NBFCs, but then tomorrow when those assets go bad, then the banks themselves will have more trouble.
You talked about how there could be more rate cuts now that the RBI has moved to a accommodative stance. Will we see a rate cut in the August policy, or will it depend on what kind of a budget Nirmala Sitharaman brings in?
My sense is that we're going to see a couple of more rate cuts, and with the change in stand, with the fact that transmission has been almost negligible or very, very limited, with this rate cut being unanimous, with them setting up a committee, my sense is that we're likely to see a couple of more rate cuts, but let's see.
Thank you so much, ma'am, for joining us. Thank you so much for watching at ThePrint.